All right, today we are diving into a really fascinating book by Patrick Kelly called The Retirement Miracle. Now, this book makes some pretty bold claims, and it really challenges the way a lot of us think about saving for retirement, starting with a pretty serious warning about the country's finances. So, the book kicks off with this quote, and it's a chilling one. This comes from the guy who is basically the top accountant for the entire US government. And this quote really sets the stage for the whole argument. The idea that the financial reality we're all in is a lot more serious than we're being told. Okay, so the first big problem the book lays out is what it calls America's hidden debt. The whole idea here is that the numbers you see on the news, they don't even begin to tell the whole story. And this slide really highlights that claim. You see this massive gap, right? On the left, you have the official number, 14.3 trillion. But the book argues that unlike a regular company, the government doesn't account for its long-term promises, things like Social Security and Medicare. And when you add those promises in, the number just explodes to 76.1 trillion. Yeah, the book really wants you to let that number sink in. $76.1 trillion, and it's presented not as some far-off problem, but as a debt that exists right now. It's just not on the official balance sheet. To try and make a number that huge feel, well, real, the book uses this incredible analogy. Think about it. A million seconds ago was just about 11 days ago. A billion seconds ago was 1988. But a trillion seconds ago, you would be back in the Stone Age. It just shows the insane scale of the debt being discussed here. So this leads to a pretty big question the book poses. If the government really owes this much money, where in the world is it coming from? And the book's answer is pretty blunt. It argues that when you're facing a tsunami of debt, the government really only has one tool to deal with it: taxation. So according to this view, much higher taxes in the future aren't just a possibility, they're practically a mathematical certainty. Okay, so moving on from taxes, the second major threat the book zooms in on is a potential flaw in one of the most common pieces of investment advice out there, the buy and hold strategy. And it asks a really tough question. The book points to Japan's stock market as a real-world cautionary tale. You know, we're always told that markets always come back. But what if they don't? Or at least, what if they don't come back in time for your retirement? If you invested in Japan's market at its peak in 1989, you were still down a whopping 76% 2 full decades later. And this slide just lays it out so clearly. Look at the difference. In the real world, your $1,000 would have shrunk to $271. But in the book's hypothetical scenario, where you just magically avoid the losing years and get 0% instead, that same $1,000 would have grown to over $2,200. The difference is just absolutely staggering. And to make this risk feel personal, the author tells the story about a guy named Tom. I mean, this guy did everything right. He built up a nest egg of $2.5 million. But then, in the 13 months right before he was supposed to retire in 2008, the market crashed and wiped out more than half of it. It's a gut-wrenching story about how devastating a big loss can be at the worst possible time. All right, the third and final problem the book really hammers home is something it calls the big lie of average returns. The whole point is that the way investment performance is talked about can be totally misleading. Okay, let's walk through this because this concept is so important to the book's whole argument. You start with $1,000. Year 1, you lose 50%. Boom, you're down to $500. Now, year 2, you get a 50% gain. You'd think that would get you back to even, right? But it doesn't. A 50% gain on $500 is only $250, so you end up with $750. Your average return is 0, but you've actually lost a quarter of your money. So what's the bottom line here? It's that negative years have a huge, outsized impact. The book argues that as soon as you have even one down year, that average return number you always see advertised becomes, well, kind of meaningless. Your actual growth is always going to be lower. Okay, so after painting this pretty grim picture, hidden debt, market crashes, tricky math, the book finally pivots. It moves from all the problems to what it presents as the solution. And the solution, according to the author, is a very specific financial product called Indexed Universal Life Insurance, or you'll see it called an IUL. It's basically a life insurance policy that has a cash investment component tied to a stock market index, like the S&P 500. So how is this thing supposed to be a miracle? Well, the book breaks down how this product is specifically designed to fight those 3 big problems we just talked about. This slide is a perfect way to visualize the core idea. On the left, you have traditional investing, You're on the roller coaster. You go up, you go down. On the right, you have the strategy the book talks about. You get growth when the market goes up, but if the market goes down, you don't lose anything. You hit a floor of 0%. So let's break down the features. First, that protection from loss. That 0% floor is a contractual guarantee. Second, you get upside potential, but there's a trade-off. Your gains are usually capped. Third, something called an annual reset locks in your gains each year so you can't lose them in a future downturn. And finally, and this ties back to the first problem, the book says you can access your money tax-free, which it positions as the answer to rising taxes. The book boils its entire philosophy down to this one really catchy phrase: zero is your hero. The idea is that if you can just eliminate the losses, if you make your worst-case scenario zero, you create a foundation for much more consistent and predictable growth over the long run. So to bring it all together, the book's argument is pretty straightforward. The problem, it identifies these huge threats like debt, market risk, and bad math. The solution, it puts forward this one specific vehicle, the IUL, as being uniquely designed to protect you from those exact risks. And that really brings us to the final thought here. The core idea in The Retirement Miracle is really a fundamental shift in mindset. It's about moving away from chasing the highest possible returns and instead focusing on making sure you never lose. And it leaves us with a great question to think about. How might a strategy of prioritizing safety first before growth change the way you approach your own financial future?